Something just happened in the gold markets that has institutional traders scrambling. And I'm not talking about the usual price fluctuations we see day to day. I'm talking about a structural shift in the physical gold market that's creating pressure unlike anything we've seen in decades. The kind of pressure that doesn't just move prices, it breaks markets. Let me show you what's happening right now, because the signs are everywhere if you know where to look. The COMEX, which is the primary exchange where gold futures are traded in North America, is experiencing something extraordinary. The ratio of paper gold contracts to actual physical gold available for delivery has reached levels that would make any risk manager nervous. We're seeing registered gold inventories, the gold that's actually available for delivery, sitting at levels that represent just a fraction of the outstanding contracts. Think about that for a moment. It's like a bank that issued 1,000 withdrawal slips, but only has enough cash in the vault to honor 50 of them. But here's where it gets really interesting. Central banks around the world have been net buyers of gold for multiple consecutive years now. Not just buying a little here and there, but accumulating at a pace we haven't witnessed since the early 70s. The People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland, they're all loading up. And they're not buying paper contracts, they're taking physical delivery. Bars, coins, the real thing. They're pulling metal out of the system and locking it away in their vaults. Now you might be wondering, why does this matter? Well, the gold market operates on a fractional reserve system, much like banking. For every ounce of physical gold that exists, there are multiple claims on that same ounce through futures contracts, ETFs, and other paper instruments. This works fine when everyone's content to trade paper back and forth. But when people start demanding physical delivery, when they want to convert those paper claims into actual metal, that's when the system gets stressed. And right now, we're seeing stress levels that are off the charts. Let me paint you a picture of what's happening on the ground. Refineries in Switzerland, which process a significant portion of the world's gold, are running at capacity trying to meet demand. Premium charges for physical gold bars over the spot price have been climbing. In some markets, particularly in Asia, buyers are paying substantial premiums just to get their hands on physical metal. That's not normal. In a healthy market with plenty of supply, premiums stay tight. When premiums blow out, it's telling you something. It's telling you there's a shortage of physical metal relative to demand. And before we go further, I want to mention something quickly. If you're watching this and you've got retirement savings you're concerned about protecting, I put together a free guide that breaks down the wealth preservation strategies thousands of American retirees are using right now. It's in the description below. No cost, just information that might be valuable given what's happening in these markets. Now, let's talk about what's driving this shortage, because it's not just one thing. It's a perfect storm of factors all converging at once. On the supply side, gold mining production has essentially plateaued. Despite higher prices, we're not seeing a surge in new production. Why? Because it takes years, sometimes over a decade, to bring a new mine online. You need to find the deposit, get permits, build infrastructure, and actually start extracting ore. The easy gold has already been found. What's left requires going deeper, processing lower grade ore, operating in more challenging environments. It's more expensive and more time consuming. Meanwhile, demand is surging from multiple directions simultaneously. You've got central banks buying. You've got Asian consumers, particularly in China and India, where gold is deeply embedded in the culture, buying for weddings, festivals, and wealth preservation. You've got institutional investors who are looking at the macro environment, the debt levels, the monetary policy uncertainty, and deciding they want exposure to hard assets. And you've got industrial demand from the technology sector, because gold isn't just for jewelry and investment. It's a critical component in electronics. But there's another layer to this that most people aren't paying attention to: the geopolitical dimension. We're living through a period of significant realignment in the global financial system. Countries are increasingly questioning the dominance of the dollar as the world's reserve currency. They're looking for alternatives. And gold, which has been money for thousands of years, which has no counterparty risk, which can't be printed or devalued by any government, is looking increasingly attractive. Think about what happened when certain countries had their dollar reserves frozen due to sanctions. That sent a message to every other nation. Your dollar holdings are only as secure as your relationship with the country that issues them. Gold doesn't have that problem. Gold held in your own vault is yours, period. No one can freeze it, sanction it, or take it away. That's why we're seeing this rush by central banks to repatriate their gold, to bring it home from foreign vaults, and to add to their reserves. Now, let's connect this to what's happening in the futures market, because this is where things get really fascinating. The COMEX operates on a system where most contracts are settled in cash, not physical delivery. Traders buy and sell contracts, prices move up and down, and at expiration, they settle the difference in cash. Only a small percentage of contracts actually result in physical delivery. The system is designed around this assumption. But what happens when that assumption breaks down? What happens when a significant number of contract holders decide they want the actual metal? We've seen hints of this stress already. There have been months where the amount of gold standing for delivery, meaning contract holders who are demanding physical metal instead of cash settlement, has spiked dramatically. The exchange has had to scramble to find metal to deliver. They've had to pull from registered inventories, which are already thin. And each time this happens, it tightens the market further. It's like a game of musical chairs, where someone keeps removing chairs, but the music hasn't stopped yet. Here's what makes this particularly concerning. The derivatives market for gold is enormous. We're talking about notional values that dwarf the actual physical market by orders of magnitude. Banks and financial institutions have built complex positions using gold derivatives for hedging, speculation, and arbitrage. These positions are predicated on the assumption that the paper market and physical market will stay in sync, that you can always convert paper to physical if needed. But if that assumption breaks, if we reach a point where paper and physical decouple, where the paper price and the physical price diverge significantly, the unwinding of those positions could be catastrophic. Let me give you a historical parallel. Back when the London gold pool collapsed in the late 60s, you had a similar situation. Central banks were trying to suppress the gold price by selling physical metal into the market, but demand was relentless. Eventually, they ran out of gold to sell, and the system broke. The gold window closed, the dollar's link to gold was severed, and the price of gold went on a historic run. We're seeing echoes of that dynamic today, except this time it's not governments trying to suppress the price, it's the structure of the paper market itself that's creating the vulnerability. Now I want to talk about what this means for the average person, because this isn't just an abstract financial market story. This has real implications for anyone who has savings, who has a retirement account, who's trying to preserve wealth in an uncertain world. When you have a shortage in a critical market like gold, it doesn't just affect the price of gold, it affects confidence in the entire financial system. It raises questions about the reliability of paper assets, about the stability of currencies, about where real value actually resides. Think about your retirement account for a moment. If it's like most people's, it's probably heavily weighted towards stocks and bonds. Paper assets, claims on future cash flows. Those assets are valuable, but their value is dependent on a functioning financial system, on stable currencies, on trust in institutions. Gold is different. Gold is no one's liability. It doesn't depend on any institution's promise to pay. It's been recognized as valuable for millennia, across every culture, every civilization. When systems break down, when trust erodes, gold tends to hold its value. And speaking of retirement accounts, if you're sitting on $100,000 or more in retirement savings, you might want to look into how gold IRAs work. I put together a comprehensive guide that explains how you can get physical gold into your retirement account without triggering tax penalties. It's in the description. It covers the mechanics, the rules, the considerations. Worth checking out if you're thinking about diversifying your retirement holdings beyond traditional paper assets. But let me get back to what's happening in the market right now. The shortage we're seeing isn't just about supply and demand in the traditional sense. It's about a fundamental mismatch between the paper market and the physical market. For years, the paper market has been the tail wagging the dog. Futures trading, which is mostly speculative and doesn't involve physical metal, has been setting the price. But when physical demand surges, when people want actual metal and not just exposure to the price, that dynamic starts to flip. The physical market starts to assert itself. And because the physical market is much smaller than the paper market, it doesn't take much physical demand to create serious tightness. We're seeing this play out in real time. Look at what's happening with gold ETFs. Some of the major gold ETFs have been experiencing outflows, meaning investors are selling their shares. But at the same time, the price of gold has been resilient, even rising. How does that make sense? It makes sense when you understand that the physical market is driving the price, not the paper market. Central banks buying physical, Asian consumers buying physical, refineries struggling to keep up with physical demand. That's what's supporting the price, even as some paper gold holders are selling. And here's another piece of the puzzle. Mining companies, the ones actually producing gold, are not hedging their production the way they used to. Hedging means selling future production forward at a fixed price to lock in revenue. In the past, when gold prices were lower and more volatile, miners would hedge extensively. But now, many miners are choosing not to hedge, or to hedge much less. Why? Because they believe the price is going higher. They don't want to lock in today's price when they think tomorrow's price will be significantly better. That tells you something about what the people closest to the physical market are thinking. Let's talk about what could trigger this situation to escalate. There are several potential catalysts. One is a major financial institution or sovereign entity deciding to take large-scale physical delivery from the COMEX or LBMA. If a big player shows up and says, "I want my gold, and I want it now, and I want it in physical form," that could expose just how thin the physical inventories really are. It could trigger a rush by other holders to demand physical delivery before the metal runs out. That's a classic bank-run dynamic, except it's happening in the gold market. Another catalyst could be a currency crisis. If confidence in a major currency erodes rapidly, if people start questioning whether their paper money will hold value, they tend to rush toward hard assets. We've seen this throughout history: Weimar Germany, Zimbabwe, Venezuela. When currencies collapse, people scramble for anything tangible: gold, silver, real estate, commodities. And in a world where many currencies are backed by nothing but government promises, where debt levels are astronomical, where central banks have been creating money at unprecedented rates, the risk of a currency crisis is not zero. Or consider a geopolitical shock, a major conflict, a breakdown in international trade, a fracturing of the global financial system into competing blocks. Any of these could send investors rushing towards safe haven assets. And gold is the ultimate safe haven. It's liquid. It's recognized globally. It's no one's liability. In times of crisis, gold tends to be one of the few assets that maintains or increases its value. Now, I want to address something that often comes up in these discussions. Some people say, "But gold doesn't pay interest, it doesn't generate cash flow, why would I want to own it?" And that's a fair question. Gold is not an income-producing asset. You don't get dividends. You don't get interest payments. What you get is preservation of purchasing power over long-time horizons. You get insurance against systemic risk. You get an asset that's negatively correlated with many other assets in your portfolio, meaning when stocks and bonds are struggling, gold often does well. Think of gold as financial insurance. You don't buy insurance hoping to use it. You buy it hoping you never need it, but knowing it's there if you do. And right now, with the level of uncertainty in the world, with the structural issues in the financial system, with the shortage developing in the physical gold market, that insurance is looking more valuable than ever. Let me walk you through what the smart money is doing. Central banks, as I mentioned, are accumulating. But it's not just central banks. Family offices, the entities that manage wealth for ultra-high net worth individuals, are increasing their gold allocations. Pension funds are taking another look at gold as a portfolio diversifier. Even some hedge funds, which traditionally haven't been big gold holders, are adding positions. These are sophisticated investors with access to the best research, the best analysis, the best information, and they're choosing to own gold. That should tell you something. But here's what's really interesting. The accumulation is happening quietly. It's not being broadcast. It's not being hyped. It's happening in the background through steady, consistent buying. That's how smart money operates. They don't chase. They don't panic buy. They accumulate methodically when they see value and when they see risk. And right now, they're seeing both. The technical picture in gold is also worth examining. We've seen gold break through resistance levels that it held for extended periods. We've seen it establish new support levels. The chart pattern suggests a market that's in a structural uptrend, not just a temporary spike. And when you combine that technical strength with the fundamental drivers we've been discussing, the supply shortage, the central bank buying, the geopolitical uncertainty, you get a compelling case for higher prices ahead. But let's talk about the risks, because no investment is without risk. Gold can be volatile. It can have sharp pullbacks. It can go through extended periods where it doesn't do much. If you're buying gold, you need to have a long-term perspective. You need to be able to weather the volatility. You need to understand that gold is not a get-rich-quick scheme. It's a wealth preservation tool. It's a hedge against systemic risk. It's a portfolio diversifier. There's also the question of how to own gold. Do you buy physical coins and bars? Do you buy shares in a gold ETF? Do you buy mining stocks? Each approach has pros and cons. Physical gold gives you direct ownership, no counterparty risk, but you have to worry about storage and security. ETFs give you easy exposure and liquidity, but you're trusting the fund to actually hold the gold they claim to hold. Mining stocks give you leverage to the gold price, but you're also taking on company-specific risk, operational risk, management risk. For many people, particularly those thinking about retirement, a gold IRA can be an attractive option. It allows you to hold physical gold in a tax-advantaged retirement account. You get the benefits of gold ownership, the physical metal, while maintaining the tax treatment of a retirement account. But you need to understand the rules, the approved depositories, the custodian requirements. That's why I put together that guide I mentioned earlier. It walks through all of this in detail. Now let's project forward. Where does this shortage lead? If the current trends continue, if central banks keep buying, if physical demand stays strong, if mine production stays flat, we're heading toward a situation where the paper market and the physical market could diverge significantly. You could see a scenario where paper gold trades at one price, but if you actually want to buy physical metal, you have to pay a substantial premium. We've already seen hints of this in certain markets. If it becomes widespread, it would represent a fundamental breakdown in the gold market structure. And if that happens, the implications extend far beyond gold. It would raise questions about other commodity markets. It would raise questions about the reliability of futures markets in general. It would raise questions about price discovery mechanisms. It could trigger a broader reassessment of paper assets versus physical assets across the board. Think about what happened in the nickel market not too long ago. A short squeeze forced the London Metal Exchange to halt trading and cancel trades. The market broke. Participants lost confidence. It took months to restore normal functioning. Now imagine something similar happening in gold, which is a much larger, much more important market. The ripple effects would be enormous. This is why what's happening right now matters. This isn't just about the price of gold going up or down. This is about the structure of a critical market, showing signs of stress. This is about a shortage developing in an asset that's been a store of value for thousands of years. This is about the potential for a significant disruption in the global financial system. So what should you do with this information? First, educate yourself. Understand what's happening. Understand the dynamics. Don't just take my word for it. Do your own research. Look at the data. Look at what central banks are doing. Look at the supply and demand fundamentals. Form your own conclusions. Second, assess your own situation. What's your risk tolerance? What's your time horizon? What are your financial goals? Gold might make sense for some people and not for others. It depends on your individual circumstances. But given what's happening in the world, given the shortage developing in the physical market, given the uncertainty we're facing, it's worth at least considering whether gold has a place in your portfolio. Third, if you decide gold makes sense for you, think carefully about how to implement that decision. Are you buying physical? Are you buying ETFs? Are you buying mining stocks? Are you using a gold IRA? Each approach has different characteristics, different risks, different benefits. Choose the one that aligns with your goals and your situation. And finally, maintain perspective. Gold is not a magic solution. It's not going to solve all your financial challenges, but it can be a valuable component of a diversified portfolio. It can provide insurance against scenarios that would be devastating for other assets. It can give you peace of mind knowing you own something tangible, something that's held value across millennia, something that's no one's liability. The shortage we're seeing in the gold market is real. The pressure building in the system is real. The potential for disruption is real. Whether that disruption materializes and when and how severe it is those are unknowns. But the warning signs are there. The smart money is paying attention. And if you've got wealth you want to protect, if you've got retirement savings you're concerned about, if you're looking at the state of the world and feeling uneasy about the future, you should be paying attention too. Before I wrap up, I want to mention one more thing for those of you who've watched this far. If you're an American retiree with at least $100,000 in any retirement account, and you want to learn more about protecting your wealth through these uncertain times, I'm offering an exclusive one-on-one educational web conference. No obligation, no pressure, just education. It's only available to people who mention they watched this video. The details are in the description. It's a chance to get personalized guidance based on your specific situation. The gold market is sending us a signal. A shortage is developing. Pressure is building. The question is not whether this matters. The question is what you're going to do about it. Because when the music stops, when the shortage becomes acute, when the scramble for physical metal intensifies, it's going to be too late to position yourself. The time to act is before the crisis, not during it. The time to prepare is when things are still relatively calm, not when panic has set in. Look at what's happening. Look at the data. Look at what the institutions are doing. And then make your own informed decision about whether gold deserves a place in your wealth preservation strategy. Because what's unfolding in the gold market right now is not just another price move. It's a structural shift. And structural shifts create opportunities for those who see them coming and risks for those who don't.